Warren Buffett's favorite indicator about the stock market is flashing bright red warning lights right now, and he's following its advice. He's selling shares like never before and stockpiling cash like never before. So first, what is this indicator? This indicator is the total US market cap to GDP ratio. So let me explain what exactly we're looking at here. But if you don't know who I am, my name is Joe Brown. I'm a former stockbroker. I spent years advising the top 1% on how to manage their wealth. And after I made enough money to leave that world behind, I turned my attention to teaching regular people financial strategies that exist outside the mainstream. Things you're never going to hear from your financial advisor or your stockbroker. For instance, Warren Buffett's favorite indicator about when to buy and when to sell, because your broker only wants you to ever buy. It's how they make money. But what we are looking at here is the total market capitalization of all US publicly traded companies. This index is the Wilshire 5000 index, and it includes all of the companies in the major indexes like the S&P 500 and the NASDAQ and the Dow and the Russell 2000. So the Wilshire 5000 gives you the best idea of the total value of all of the publicly traded companies in the United States. And then we are comparing that value to the value of the GDP of the United States. GDP is the measure of the value of a nation's economic output, or in other words, everything a country produces. So if we were to put this into individual financial terms, the Wilshire 5000 would be like the value of your brokerage account, the size of your assets, whereas the GDP would be almost like your personal income for the year. Now, from an individual standpoint, there's not a relationship between those two things. Like, you're not gonna have your income be negatively affected if your brokerage account gets too big. But the reason why the Wilshire 5000 to GDP ratio is Warren Buffett's favorite indicator is because there is a correlation that exists that way. In other words, when the value of the total stock market gets too big relative to the size of the actual productive economy, it could indicate that those assets are being overvalued. So if we wanted to tweak the individual example a little bit, it would be like somebody is assigning us a market cap or a value. Like, what are you worth if they wanted to buy you? They'd look at your income and they'd say, okay, we can produce this much, so I'm gonna assign this much of value to you. If I were to buy you, I could reliably get that income. Now, it sounds like I'm talking about slavery here, but just we're using an example here. So we're talking about the stock market. If the value of the total stock market is too high relative to the productive capacity of the economy, then it would indicate people might be paying too much for those assets, that we are in bubble territory, that the productive capacity of the economy is not great enough to support the valuation being assigned to those assets in that economy. I'm gonna get canceled for this one, huh? Okay, so let's take a look at the actual numbers on this ratio and what Warren Buffett is doing about it. We can see that we have recently exceeded 200%. Now, this is the highest the Warren Buffett indicator has ever been. The last time we were close to this high was at the end of 2021, when we almost got up to 200%. If you remember your stock market chart, that was right before the bear market started in the beginning of 2022. Now, this black line that you see running across the middle all the way, that's the mean, or in other words, that's the average level that this indicator usually sits at. So from the 70s through the 90s, this indicator was well below the current average, whereas really for the last 25 years, this indicator has usually been well above the average. Even so, we can see that this indicator usually gets pretty high preceding market crashes, like it did before the financial crisis and like it did before the dot-com bubble burst. We can also see this quick peak and drop of the Warren Buffett indicator right before the crash that happened at the beginning of 2020. Now, just because an indicator has reached a record high does not mean it cannot continue to move higher. In fact, that's the only way you get new records, is by something happening that has never happened before. So we could absolutely see this indicator get much, much, much higher before it ever comes down, or it may never come back down. I'll talk about how that could happen at the end. But this indicator has done a pretty decent job of indicating frothiness or bubbliness in the stock market, especially when you pair it with what Warren Buffett is actually doing about it. Warren Buffett is building a massive, insane cash pile on hand at Berkshire Hathaway, exceeding over $320 billion just a few months ago. You can see that it has more than doubled in the last year. Now, Berkshire Hathaway gets its cash from a couple of sources. Number one, it's gonna get cash from the income, from the dividends of its stock portfolio. Berkshire Hathaway is basically the Warren Buffett mutual fund, so it owns a ton of shares from a bunch of different companies. And so any dividends or income that those companies produce will go onto the balance sheet at Berkshire Hathaway. Berkshire Hathaway can then choose what they do with that cash, whether it's reinvest and buy more shares or just keep that cash for a purchase later on. And it seems that is what they're doing with basically all their cash right now. But that cannot explain where the majority of this cash came from. That is explained by stock sales. Over the last year, Berkshire Hathaway has engaged in some crazy stock sales. Most notably, he's been dumping Bank of America shares and Apple shares. In fact, Berkshire Hathaway has dumped half of its total Apple shares. Now, Warren Buffett said this was to pay taxes, but if he thought Apple was still fairly valued or undervalued, he'd be selling something else to pay taxes, not Apple. And given the fact that Apple is trading right up near all-time highs, would indicate that Warren Buffett might be looking at Apple as overvalued. But it doesn't stop there, because in addition to the crazy amounts of stock sales Berkshire Hathaway has been engaging in, what's most intriguing is the lack of buying. In fact, for the last 6 years, Berkshire Hathaway has been buying back its own shares until now. And the company stated that Buffett will start buying Berkshire Hathaway shares back again once he feels like the stock price is below Berkshire's intrinsic value, conservatively determined, which means that by definition then, if he's only gonna buy when he thinks that at a conservative valuation, he's able to buy below the intrinsic value, he does not think that Berkshire Hathaway is below its intrinsic value. He thinks it's above its intrinsic value, therefore overvalued. So what should the average person do about this? Well, there are 3 ways that you can look at this. Number 1, you can say, I'm just a long-term investor. I'm just gonna dollar cost average in. I've got 15, 20 years until I plan on using this money, so I don't care if there's a slight pullback. Heck, I don't even care if there's a 25, 40% crash, because in the long term, markets usually recover and then some. The second way to approach this is a little bit more tactical and following in the footsteps of a seasoned, very good investor like Warren Buffett, saying, I'm gonna keep a little bit extra cash on hand. Maybe I'm gonna sell a portion of some of my positions that seem the most overvalued, or some of my positions that I think are probably companies I don't really want to own. And I'm gonna buttress up my cash position, just have a nice little cushion, a pillow of cash to sleep on, so that if something happens, I've got dry powder to be able to buy when things are on sale. There's absolutely nothing wrong with that, but be warned. When you see the stock market continue to make new highs and things continue to get to crazy prices, you are going to look at that cash pile and you're going to be killing yourself, and you're probably going to convince yourself to reinvest it all right at the top before the crash happens that you were actually waiting for all along. So if you are going to build up a little cash pile, a little bit of dry powder so you can buy things when they go on sale, don't actually buy things until they go on sale. It's gonna take a lot of discipline, a lot of courage, and a lot of ignoring the fear of missing out. But if you do it correctly, you can make fortunes during bear markets. As they say, you make money on the buy, not on the sale. And the third way to approach this is to basically just say, well, Warren Buffett is wrong, because this indicator could go up indefinitely. Now, this is what I alluded to earlier, that this indicator could continue to move up and up and up forever. And here's how. Inflation. We all know there's a huge debt problem. We all know there's a huge government spending problem. We all know there's not enough money in the system for the government to service that. The only way out is through an inflationary deleveraging, where the government with the Fed prints money in order to pay its bills and in order to keep on servicing its debt, in order to offload the pain and the cost of that debt onto the economy. This pushes up the prices through the money supply being increased, and we have an inflationary deleveraging from the government, where all of the other prices and interest rates for everybody else goes up. In this case, the people who have the money first buy assets because they want to protect themselves from that inflation, which means asset prices go through the roof and people stop caring about valuations. The only thing they care about is protecting themselves from the devaluation of the currency, which is why you see crazy stock market charts from places that have experienced hyperinflation, like Venezuela, where it literally just goes parabolic, or the price of gold during hyperinflation in the Weimar Republic. When you get hyperinflation in a currency, you get hyper growth in the valuation of assets, which means there's a very possible future in which this chart no longer matters, in which the only thing that matters is protecting yourself from that currency devaluation. Now, I am not saying we are there. I am not saying that we are experiencing hyperinflation right now or that we have hyperinflation waiting for us around the corner. But I am saying that we probably have higher inflation ahead of us than most people expect. And that asset prices going up are usually an advanced sign of that inflation coming around the corner. Now, if you want me to help you apply ideas like this to your investing so you can grow your portfolio during the good times and protect it during the crashes, go ahead and click on the link in the description below. As always, thanks so much for watching. Have a great day.